then you better start swimming or you'll sink like a stone. Oh, the times they are a-changing.
All right. That was March the 8th, 1965. Bob Dylan released The Times They Are A-Changin'. And maybe that's what's starting to happen with the U.S. economy, and particularly the mortgage-backed securities market. We've seen an interesting week in mortgage-backed securities. It's been a bloodbath, as we all know, so far in 2022. Mortgage interest rates shooting up upwards of 2 points, really tightening the pocketbooks of the American home buyer, of anyone looking to refinance. Certainly affordability has gotten the squeeze with interest rates on the rise. This is all about inflation, and inflation has been the drum we've been beating, the topic we've been talking about since January of 2022. And now we are starting to see perhaps the tipping point from historic highs of inflation we haven't seen in 40 years, and things are starting to mitigate. Let me show you what I'm talking about. I'll flip the screen around here. Get rid of you, Bob. Sorry, we'll see you. These are mortgage-backed securities. Mortgage-backed securities are the financial instrument upon which interest rates are based. Red days are bad days, meaning interest rates are headed higher. Green days are good days, meaning interest rates are headed lower. And lo and behold, take a look since May the 18th. 1, 2, 3, 4, 5, 6, 7 days out of 8. 7 out of 8 business days, mortgage-backed securities have rallied and increased in value, thus lowering mortgage interest rates. Now, mortgage interest rates aren't dropping back to historic lows, but we are seeing some improvement. And boy, improvement has been hard to come by so far this year. Let me show you why perhaps we're seeing some of this improvement, and it's really all in the data. Thank goodness we're back to talking about data. So here's what happened this week. We saw some interesting numbers come out. New home sales coming out at 591,000 against an expectation of 750,000. That's a big miss. That's a sign that everything is slowing down. Durable goods coming in below expectations, even excluding transportation, coming in even further below expectations. Jobless claims are right about what we thought, but take a look at this. A revision to the first quarter GDP showing that first quarter GDP shrunk even more than what we had anticipated. So first quarter GDP shrinking by 1.5, and then pending home sales index, that's decreased below expectations. Take a look as we move further throughout the week. Now we're at the Fed's favorite measure of inflation. This is personal consumption expenditures. Came in below expectations. 6.3, now 6.3 still a very high number. It's way too high of a number for inflation, but lower than what we anticipated at 6.6. And if we take a look at consumer sentiment is down versus estimates. All of those things point to one conclusion, that perhaps the peak of inflation, the run-up in inflation, is now behind us, and we are coming down. Albeit slowly, we are coming down from those peak inflation numbers. Some other things that are going to be kind of interesting to watch. When you talk about how we got here in terms of inflation, we got here because of a lot of stimulus monies, right? We got here because of supply chain issues. We got here because now there's too much money chasing too few goods. Speaking of that, let's talk about the personal savings rate. So here's the personal savings rate as pulled from the St. Louis Fed, and I'm just going to pull from about 2016 up to present day. And we all know what happened right here in the pandemic. The personal savings rate hit an all-time high for the United States at 33.8. This is April of 2020. Americans were saving all kinds of money. Why? Because they couldn't go anywhere. We couldn't travel. There were no concerts. We're not going out to eat. We're not taking vacations. So what are you going to do with your money if your job was not impacted significantly by COVID? You're going to put it in the bank. And that's what everyone did because there was nothing else to do with it. And as we saw the pandemic progress and we saw the Delta variant hit, the personal savings rate peaked again in March of 2021. But since then, been on a pretty sharp decline as we move forward all the way here to April of 2022. And folks, I want you to take a look at that number. 4.4 is the personal savings rate, meaning not saving much at all. If you put it in historical context, let's zoom out a little bit and put it in historical context. 4.4 as a savings rate, woo! We haven't been at 4.4 since somewhere in the late 2000s, before 2010. And that tells you one thing, that Americans are out there spending. They are not saving any longer, honey. So we are pulling that money out of the savings accounts and we are going to town, out to eat, travel, going on obviously vacations, where we are buying concert tickets, we are buying new cars, we're doing whatever that we're doing with all of that pent up savings. And it's going to take time to use it all up because we had a pretty incredible savings rate. But that time has passed and now we're in spending mode and not saving a whole lot. Tells me that the times, they are a changing. Let's talk about one other interesting point. Now, all banks have to report a loan to deposit ratio. So banks loan money, and we know banks have money on deposit. And the loan to deposit ratio is an important factor when evaluating what's happening with the economy. And you may be asking yourself, hey, if interest rates are headed higher, and we've all seen interest rates go up, whether it's the Fed funds rate or mortgage interest rates or whatever, why isn't my savings account earning me more at the bank? I thought interest rates were relative. If rates are higher over here, shouldn't they be higher over here? Well, there's a reason why the bank hasn't raised the amount they're paying you on your savings account, because they don't want your money anymore. They've got too much money on deposit as is. And when you start talking about the loan to deposit ratio, banks really make their money by loaning it out, not by taking it in on deposit, at least not as much by taking it in on deposit. And the problem for banks right now is that the loan to deposit ratios are far, far too low. And that's why you're not getting more bang for your buck when you put your money in your savings account. But it also is something to watch as we start to exit from this period of robust savings, from this period of inflationary pressure. It's something to watch what happens to the loan to deposit ratio. And let me take you over here, and I want to reference this particular bullet point on this article from Monarch Partners here. And let's take a look at this. Liquidity on bank balance sheets is at a record level today. The loan to deposit ratio of the U.S. banking sector today, 59%, which is the lowest since the early 1970s. 1970s, we're going back 50 years now. 50 years, we haven't seen this low of a loan to deposit ratio. To put this in perspective, the median loan to deposit ratio of the banking sector since 1972 is 81%. Hold on to your hats. Get ready to read this sentence. To get back to the median ratio, to get back to this 81%, U.S. banks would need to lend out $3.9 trillion. $3.9 trillion is 17% of the annualized GDP. Folks, what has happened is we had this incredible amount of personal savings, right? And we're just now starting to chew into that. But the loan to deposit ratio is what we have to watch normalize. As that starts to normalize, you're going to start to see a return to normalcy across the board for interest rates. Interesting dynamics to watch, but the times, they are changing a little bit, and we're starting to see mortgage interest rates improve because of it. If I can be of any service to you over the holiday weekend, please don't hesitate to reach out, mark.milam@highlandmtg.com. Have a good weekend.